Let's talk technicals and what the charts are telling us. Stephen Suttmeier, Chief Technical Strategist at Bank of America's Global Research. And I feel a little better after looking at your notes, actually, Stephen. So not to worry, seasonal corrections occur during this time. Nothing that you see right now tells you it's anything more than that, and an upward trend could resume in the next good time, which begins in November?
That's correct, yeah. So if you follow seasonality of the market, you typically get a summer rally, into July, August. So, and after that, you typically get the fall correction. So the second best 3-month period of the year happens to be June through August. The worst 3-month period of the year happens to be August through October.
Are we through the worst of it? Is there more to come?
Yeah, good point. I mean, when I'm looking at some of the tactical sentiment indicators, I mean, we do have some important support levels that we're at now, right around 4,300 on the S&P. But when you look at something like the put-call ratio or the 3-month VIX versus VIX, they're coming down, but they're not climactic yet, meaning not enough near-term fear in the market that was associated with past lows in the market. So I actually think the low could happen below this 4,300, maybe towards 42, somewhere in the 42 handle, with those indicators triggering, meaning 3-month VIX versus VIX below 1. That's the fearful reading. And the put call, 5-day put call, for instance, somewhere in the 1.12 to 1.25 range, which is where it occurred March, December, October, and June of last year. So I think we got a little more on the downside here.
I know it's been a while, but we never retested October lows, and we never got a capitulation or any of the things you just said we never got at 3,600. So now you're talking about 4,200 as being the intermediate term low, and you just totally took those old lows that everybody was looking to retest. Why didn't we ever have a capitulation that time?
Well, I think we did. For a few reasons.
Duration, not a quick one, but a U instead of a V?
Well, I would argue this. First and foremost, we had a low in June of last year, and you retested that low in October. So that was a retest, but you did get some capitulation. One, the 3-month VIX versus VIX did get below 1 right around that time frame.
But the VIX never got above 20.
Yeah, the VIX is very strange, right? It's not really working the way it used to. So that's why I use that ratio, 3-month VIX versus VIX.
Yeah, I heard that.
And the other thing that's very interesting about last year is that when you look at AAII bears, they got above 60 in late September, around this time last year, which was the highest level that's seen since 2009.
So if you looked for it, it was there.
It was there, and we wrote about it at the time, and everyone kept saying we didn't get capitulation. I'm like, you got it from these two indicators, not from the VIX.
You should have called me because I was waiting for someone to say that we didn't need a capitulation. I had.
Well, you got it. You got it. You just didn't get it from the indicator most people are looking for it in, and that is normally what the market does.
So you don't see credit strain, or you don't see any of the scary things that would indicate that this is more than just a correction.
At this point, no. I mean, if you look at the option-adjusted spread on high yield, it's not expanding aggressively.
But thank you. You do.
That's a good one,
That's why you're here. What is it? The
option-adjusted spread on high yield, high-yield corporate bonds.
Not this morning.
It's quite low. It hit a new cycle low earlier this month. And then corporate BAA to 10-year spread's another important one, right? I mean, that one's below 2. When you get above 2.5, that's a problem. And it recently just hit another cycle low, right around 1.7 or so.
How quickly do those metrics change when you're getting into a bad time? And we've been talking about how the economy looks great until all of a sudden it doesn't.
Right.
How about those metrics? Is that the same thing? Like it looks great, but it can fall off a cliff?
Well, the beautiful thing is sometimes these indicators do have divergences. So if we were looking at late 2021, for instance, a lot of the indicators we're talking about now actually had their best levels, bull market levels, in the summer. And right now, they still have their best levels here, so there's no real divergence at this point. But if all of a sudden a 1 standard deviation event turned into a 2 standard deviation event, you would think it would show up in these credit spreads. But, I mean, again, the market has a cyclical uptrend, and if you keep it really simple, 40-week moving average around 4,200, that's the cyclical trend right there as a guideline. Secularly bullish as well. We've been big believers in the secular bull market. Maybe we're getting towards the later stages of that, but the big level to pay attention to there is that 200-week moving average, right around 3,900. Now, it's not unusual during these seasonality periods, and it's happened on past pullbacks over the last decade or so, where you go down and test the 200-day, which a lot of people look at, but I look at the 40-week because, I like to eliminate the daily noise, and that would argue that a perfectly normal thing to happen in a bearish seasonal period is to test some of those longer-term moving averages.
So he's got the technical analysis gene, the apparently. Was your mother? You have 2 copies of that, or just? You remember Rich?
Yes, of course.
Yeah.
That show, when you walked in, I'm like, who the hell are you? I was looking for your father, but he's doing well and
Oh, yeah.
living. Okay,
Either that or he found the fountain of youth, right?
Or
Or the fountain of middle age.
And
I don't
as
know.
I told you, he told me he taught you everything you know, but only 10% of what he knew is what he just.